with the ups and downs of the stock market, you want to have some in real estate.
Yeah.
And the key to real estate is really the leverage. The leverage is gonna, make sure that you have inflation protection, is gonna maximize your cash flow, maximize your cash on cash return. And the return is gonna be, even with a very low appreciation, your return on your investment is gonna be significantly more than the historical average return of the stock market.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Welcome, Decoding Cashflow listeners. Today, our guest is Eric Martel. He's a real estate investor and a founder of Flip System as well as Martel Turnkey. He's a host of a well-known podcast, Break Away from the Rat Race. Eric is also an author of Stop Trading Your Time for Money, and he advocates early retirement by building passive income. So he has he has built a turnkey system through which the investors can earn passive income and retire early. So we'll talk in more details about in our podcast. So Eric, thanks for taking out some time. Welcome to Decoding Cashflow.
My pleasure. Thank you for having me.
All right. So Eric, just to get started, if you can give our listeners a little bit overview about yourself, your background, how did you get started in real estate, and what do you do currently?
So the first real estate investment that I did, I was 18 years old. I was still at university, and I had just met this mentor, a real estate investor that had built like 36-unit apartment building. And I said, I'm interested in this real estate investing thing. And, is this true that you can buy real estate with no money down and, and still have, money and stuff like that? And he said, and so he kind of like taught me a lot of stuff. And that's when I bought my first 8-unit apartment building, 18 years old, no money down because I had no money. So, it was still cash flowing in the end. And so that kind of like got me, that was what I call my rich dad, poor dad moment, because I'm kind of comparing what my parents were teaching me, which was get a job, pay your bills, and save, and compare that to what this man was teaching me, this mentor, and saying, get a job, but invest, and invest, and invest in real estate. So that was a very big contrast for me, and I thought it was very, very interesting. And this mentor, that rich dad, really was not smarter than my parents. He was just a community college teacher, and but he was smart about kind of how he invested and about how he did real estate investing. So learned a lot from him, but it was a lot of work. And at that time, I didn't have any money, and I kind of identified the reason why. I had to analyze like 400 or 500 properties in order to find that one property that I can buy with no money down and all that kind of stuff. So I thought, this is a lot of work. And I felt like I had looked at all the properties in that area. And so I needed to find money. So that I got a regular job as an actuarial consultant. And I did that for many years. And I tried to, but I knew that I wanted to do real estate investing. And every city that I moved into, like large cities, I was trying to find real estate investments that were cash flowing and stuff like that. I could never find them. So, and then I went to worked with IT, had a ton of money with stock options, went to California, San Francisco. And then I said, well, I have all this money, all these stock options. I better start investing in real estate. So I started again looking in real estate in San Francisco Bay Area. And you can find anything that made sense. Yes, I could put a lot of money down to make it cash flow, but then my cash on cash return would have been, very low, like 1%.
Yeah.
So it was in 2000. I decided to leave the money in the stock market, and .com crash happened, and basically most of my stock options were wiped out at that point. And went back to the drawing board and say, well, I want to have control of my investment. I want to build passive income. I want to do this. And then I kind of, it helped me refocus what was important to me. And I couldn't do real estate. I did a couple of businesses with my wife. We're a very entrepreneurial family, so we did a few businesses. And it was really not, they were good businesses. I didn't lose any money, but I also didn't make any money, any significant money. And I couldn't really turn them into passive income. I had to be actively working in those businesses in order to make money. And that was not my goal. So I decided to kind of figure out, go back to the drawing board. And a lot of things had changed in that time, like a lot of technology. We can think about electronic document signing, think about your iPhone, like in 2005, 2007, you have cameras on all the phones and stuff like that, electronic document signing, as I mentioned. And then you have Zillow, that's also on the market, where now I can have access to data, market data, property data, anywhere in the United States. And so instead of being confined now to San Francisco, I felt like my boundaries were, anywhere in the US. And again, went back to the drawing board and said, okay, if I had to invest in passive and single family rental, I also looked at apartment buildings, but I decided to focus on single family rentals. Where would I invest? What's the best market for me to invest, to have cash flowing property, high cash on cash returns, and all that kind of stuff?
All right. Sounds great, man. Yep. Go ahead. No, go ahead.
So exactly. So then I went and looked at Census Bureau of Labor Statistics, combined all that in a spreadsheet, and really came up with like Memphis, Cleveland, and St. Louis to get started. So I had a list of people, but a list of markets, but I started with these markets. And that's when I bought the first house, was in Memphis. I think I paid like $45,000 or $50,000, put $5,000 down in $5,000 in repairs in the property, rented it out, and then refinanced it and got the after repair value was $70,000. I got like a mortgage after the seasoning period for $56,000. So I basically put like, and my mind was blown at that point, because I was just like, okay, I put $50,000 in, 45 for the purchase price, and then 5,000 for the rehab. And now I'm getting $55,000 or $56,000 from the mortgage. If my calculations are right, I have more money at the end of the project than I had at the beginning. And on top of that, I have an asset that is cash flowing. And I was just like, well, this is infinite return. This is unbelievable. I want more of that. So I was kind of hooked. And so I did like 2 more properties and 4 more properties. And of course, not all of them were, most of them were not unicorns like this, but most of them, there was a very significant cash on cash return after that. And that it evolved later on into friends and family asking me, and my son was also involved in this, we're also involved in this business. And they started asking me, like, what are you guys doing? Like, what are you investing in? Well, we're investing in single family rentals in the Midwest. And it's just like, what are you doing? And so yeah, and then that's kind of where things started we had people that wanted to invest with us, that in joint ventures, private money lending, all that kind of stuff. And then we had other people that they say, hey, can I buy the property from you? And once you're done with this, like, I just want to have it like with the tenant and everything, I just want to buy it from you at the end. And I say, okay. And that's the beginning of Martel Turnkey. We basically did this business. We did like maybe 1,000 houses. At the end, I think we're like at 50 properties. We were trading like 50 properties a month. So things went very well. But also, a lot of people were asking us at that point, after doing that for a few years, they said, well, I want to do what you guys are doing. I want to buy the distressed property. I want to renovate it. I want to rent it out, and I want to refinance it at the end. That's kind of what I want to do. Can you help me do that? And so we did. That's when I wrote my book, Stop Trading Your Time for Money. That's when we did online training. And then we also did the mentorship program, because I thought that, when I got started, the first deal that I did, it was because I had a mentor, someone that would show me what to do, show me what, and making sure that I was on the right track, that I was making the right decision, that I was not crazy, all that kind of stuff. And so I thought, I was for sure thought that that mentorship program was the key to success. And so we'll give you the online training, but we also give you the mentorship. And really, we didn't have the level of success that we thought. Only maybe 10%, I'm being generous here. Only 10% of the people that participated in our mentorship program were successful, actually did a deal in a market. And that was very disappointing to us. And so we just kind of went back to the drawing board, and at the beginning of this year, beginning of 2023, we launched a flip system. And this is really end to end. So it's not just the online training, it's not just the coaching, it's everything else, because we went back to the drawing board again and said, how come we don't have a higher success rate? What do they need? Well, maybe they need to have the deals. So we said, well, we could plug in the acquisitions team in there and analyze the deals and say, hey, here's some deals for you. You can just go and do these deals, execute on these deals. But then I said, well, then they're going to want to know like the team on the ground. They're going to want to have the realtor, because it's a lot of effort to find the team on the ground, vet the team on the ground. So maybe we can share the teams that we've worked with. The property man, the people on the ground that you can rely on, that we've worked with for many years, and you can use them. And then the last piece was really about the hard money lending. How do they find money to do these deals? And more recently, now we are allowing our students, our flip system student, to list their property on Martel Turnkey for sale. So they really accelerate basically getting their money back so that they can do more flips. And so that's really, I mean, end to end, everything is there for you, done with you. So you're doing everything, but you have our support all the way through.
Sounds great, man. There are a few takeaways from what you mentioned. The first is, I would say, if you're starting, it's better to have a mentor. It will shorten out the period of success.
Yes.
On your own, right? If you're determined to do something on your own, yes, you can do it, of course, but it will take a longer time, and you will do some mistakes, And if you have a mentor, they'll be able to shorten up the period, and you can learn from their mistake, their network, So that's one thing.
Right. I mean, a lot of people, they talk to me and they say, well, why can't I do it on my own? Absolutely, you can. There's no doubt in my mind that you can do it, but you have to be very disciplined. You have to be self-motivated. Exactly. And it takes a long time to build all of that together. It took us a few years before we really hit our stride. And we knew we had the right team on the ground. We knew how to analyze properties for profit, to maximize our profit. We had all the lending organized. We had private money lenders, joint venture. We never used hard money lender. And and before we got that it took us a couple of years really for us to really be in a good rhythm, and then able to scale after that.
It takes a while to lay up all the groundwork, right?
Yes.
So that's what it is. And the other thing is, as you said, right, in the .com era, during the burst, you lost most of the stock options. So always be diversified. Don't put all your eggs in one basket, especially the stock market. It's just a paper money. You never know when it will crash. Yes, in a real estate, yes, there are ups and downs, but in the long term, it's always up. And if you find, as you say, the niche that you are working on, right? Even if there is a downturn in the property market, and if the property is cash flowing, you don't have to worry about it.
Yeah.
Even if the property prices goes down, it's cash flowing. You keep it, you hold it, you pay your mortgages. And after 15, 20 years, it's mortgage free. You own it full. So, yep.
Yeah, I want to hit on the diversification. You mentioned diversification. See, I thought I was diversified. So I had converted some of my stock options, but I converted them into stock. So I invested in stock, but a bulk, massive amount of money was in the stock market. And I thought I was diversified because I had different stocks. I probably had like 50 or 100 stocks in my portfolio. And I thought, okay, this is, I'm diversified, but that's not diversification. You want to be diversified across different assets,
exactly.
Right. So this is the key here, especially if we're gonna, the ups and downs of the stock market. You want to have some in real estate. And the key to real estate is really the leverage. The leverage is gonna, make sure that you have inflation protection, is gonna maximize your cash flow, maximize your cash on cash return. And the return is gonna be, even with a very low appreciation, your return on your investment is gonna be significantly more than the historical average return of the stock market.
Absolutely. And you rightly said, right? Because of the leverage, your return is going to go exponential. It's like what, 20 to 80 leverage?
Yeah.
So it's 1 to 4. So if you're investing, if the appreciation is about 2% of the property, you're gaining 8% total overall appreciation.
Yep.
Yeah.
Exactly. And then on top of that, you have the cash flow.
Yep.
And then, so that's another, maybe if you look at the cash on cash return, like a very normal cash on cash return of like an 8 or 10%. I mean, you add the two together. I mean, that's kind of where you are, and you're not going to get that on the historically with the stock market. Stock market has been 9% over the last like 50 or 60 years. So.
And the other thing is, the cash on cash return, right? Once you have a mortgage on it, if it is a fixed rate mortgage, the cash on cash return is always going to increase with the increase in rent. It's not going to come down.
Yeah.
So if you're having a cash on cash return at like 8%, 10% right now, you expect to go up to 14, 15, 20% in the coming years, based on the rent increase. So that's the other thing.
Rent increase, and then your biggest cost is your mortgage payment. So that stays the same for 30 years.
30 years, exactly. Yeah. When you told us about your turnkey systems, right? Flip systems, or maybe Martel Turnkey properties. Can you give us some more detail on how you select the areas, or not only the areas, but the criteria based on which you filter out the investment opportunities for the single family houses?
Yeah. At a high level, I would say at the macro level, just to identify the broad market that we're looking at. So I'm looking for landlord-friendly states. I'm looking for very slow growth. So slow growth in population. I don't want to have like massive inflow or outflow of the population.
Why is that?
I don't want to, right? And same thing for businesses. I don't want to have like business like basically the business GDP of the market to go like 5 or 10%. I don't want that. I want a boring town that's growing very slowly, that's very stable. And so, 1% growth in terms of population max or around there. So that's the one thing, right? Because I want to have a stable market. I want to find deals. If there's tons of people going into town, that means everything is going to go up. The prices are going to go up, and there's not going to be enough supply, and I won't find a deal. But if it's something that's very stable, that means I can find pockets in the city where I can find some deals, and that's going to be very good for me. Second, after that, I look at kind of like the economics. What's the average house price, average median income, average rent or median rent? I say average, I always mean median. But so I look at all of that, and I'm kind of looking roughly, around that 1% rule. So I kind of like try to estimate what's that 1% rule in there. So from 0.85 to 1.25, I kind of look at these market, and then I do a deeper dive in the market, and then I would start looking at maybe like some specific area. I would look at, is there a lot of deals? I would go on Zillow and look at what neighborhood would I roughly go into, like all that kind of stuff. And then once I identify a market, then it's really talking to someone on the ground. So talk to a realtor, and a bunch of realtors. Normally, a lot of them don't, they don't answer, they don't reply back. But once you find a good realtor, that you can have a good conversation with, that knows how to work with investors. That's also another key element. Most realtors, they just sell retail. They don't talk to realtors. They're investors, so they don't know what an opportunity looks like, what the rent would be like, and all that kind of stuff. And then, but once you find the right realtor, then you can start talking more about the neighborhood and then which area you're looking for. And then you can really focus your attention on, in Zillow, find properties, look at things, and then have a dialogue with your realtor about opportunities. Like, should you go here? Should you go there? They may have properties that they are representing as well. And that's kind of how we're doing it. How we're doing it, sorry.
And do you do any direct mail targeting any foreclosures, property lease pendings?
No.
Do you do anything as such? No, just
so about 25% of our properties are coming from wholesalers. Then we have like about another bunch of every once in a while we have like off-market properties from the realtor, because we've been working with them for a while. At the beginning, you can't really expect that, but once you've done like 200 properties with a realtor, they kind of like me, this is a good guy, so they kind of give us a first look at some properties that they have off market, pocket deals, and then the rest is really just regular MLS deals. Like that's the bulk of it, but you have to react quickly, so you have to analyze deals like the same day that they're posted, and then decide right away, make an offer. That's the way to get these deals.
And these deals, as you said, right? They are in Missouri, I think Cleveland.
So we have a couple of markets in Ohio, so Cleveland,
Ohio.
Cincinnati,
and they're far away from your place, right?
Oh yeah,
where you live. So how do you manage these properties?
Well, so that's where the team on the ground is key, right? It takes a while to if you get started from ground zero and you're not using Flip System, it's going to take you a couple of years to really vet your team and know that, and build your team and grow the business with them. But yeah, you definitely want to have the realtor, you want to have the property management company. Sometimes they kind of come bundled together. Either the realtor has a property management company on the side, or they work for a property management company, or or they're gonna work together. They're gonna cooperate. And then the property management company and realtor, sometimes they can connect you with contractors, people that they're using. So that's kind of how you build your team. But yeah, you have to do a lot of phone calls, and then you start small. And then you start with one property, and then you do 2 and 3 and 4, And then that's kind of how you build that relationship. And you can imagine that it takes a while to ramp that up to 20 or 30 properties a month with each of these people. But once you have that, yeah, I mean, you just you just manage the property. You have a system. They know exactly what you're looking for. They know what renovations that needs to be done. So that means when the contractor goes, they already know what we want it done with it. So they're going to look at the HVAC, they're going to look at the age, they're going to look at the roof and stuff like that. They're going to do a bid. And most of the time, there's really not too many questions. They know what paint color they're going to use, what hardwood floor or we're going to use. They know all that kind of stuff. So
that's right. Actually,
our budget, and roughly our budget is around $20,000 to $30,000. So they know, hey, what can we do with $20,000 in here?
Okay. And the good thing is, right, once you have done few properties like this, you standardize the process, you standardize the material, like the paint. Okay, I need this paint in all the houses that I do. I want this kind of flooring in all the houses that I do. Yeah, maybe based on a certain aspect, like if it is a mid-level renovation, luxury renovation, you might change it. But once you have all the standard fixed, it's you know the price.
Yeah,
ready to go.
Yeah, exactly. It's very simple. It's simple for them, simple for us as well. It just makes things a lot smoother when you're doing a high volume of properties and fix and flip. Then yeah, you want to have it. These kind of you don't want to have to talk about paint colors and what hardwood floor you're gonna do and doors or hardware.
It should be all standardized.
Yeah, you want to standardize. I don't want to talk about toilet because this toilet is on sale. I'm gonna,
And the main what I hear from you is the main focus for you as well as any of your students, right? It's fix and flip, sell it out. How much percentage of the house do you keep it for yourself, or everything is 100% for sale after it's fixed?
So some of the flip system students, they have like $20,000 or $30,000 in cash that they want to invest, and then so that's not enough really. Like if they're trying to achieve financial freedom or they just want to build some passive income, it's not enough. You can't just do that because you're gonna, as you refinance the deal at the back end, you're always gonna leave some money with that property. So if you have 20 or 30 and you leave $10,000 for every property that you refinance in the back end for your passive income portfolio, you're going to be doing 3 houses and then you're going to be done. So we don't want that. We want to build the capital, and then every time maybe every 4 or every 5, you refinance one of those houses. Sometimes it's 4, sometimes it's 5. It really depends. But the idea here is that you're going to look at a lot of deals. You're going to do a lot of deals. And then we have a property tracking system with software that basically calculates kind of what's going to be your profit if you flip it, but it's also going to calculate at the same time, what if you're going to refinance it? What if you're going to keep it? How much money is going to be left in the deal? What's going to be your cash on cash return? And so it's going to calculate that. So you can see both exit strategy right there in the software. And maybe as you go through 5, 10, 20 deals, you're going to find 1, maybe 2 unicorns, like I did with my first deal, where you can basically refinance and you get all your money out. So that's these ones. I mean, you just refinance them. That's your exit strategy right there. And then that way you don't touch your capital, but you want to build your capital so that you can get the ball rolling and do more and more projects, more projects at the same time. And then eventually that passive income is going to build because you're going to buy more of these.
Buy certain houses at a time.
Exactly.
Okay. And during your investment journey, right, into these single family properties, have you come across any specific blockers, I would say, or major issues if you can describe to our listeners anything, any specific thing that they need to be careful about so that they don't face those kind of issues.
Yeah, I mean, I think you want to kind of stay, that's why you want to find your niche, right? So you want to find the right things. For us, it was really, we wanted to do about $20,000 in rehab, 20 to 30. That was, and then you look for these properties where you can do enough renovations to add value to the property. And then, so you would look at HVAC and all that kind of stuff. And you would do some of these mechanicals, repairs or upgrades, and then you would do the standard things on top of that. So that was key. You don't want to go into something that's requires like foundation issues or fire damage and stuff like that, unless this is the niche that you want to go after. But really keep it simple, and you don't want to do like also the other end, very light rehab. The light rehab, often what happens is that if you're planning to flip it, to resell it at the end, you're not adding enough value. Then the other person is going to look at it, and the buyer is going to look at it and say, well, why are you asking me for this much more money? You're not really adding any value here.
Yeah.
They will know, they will be able to know that, you bought the property here at this price because it's going to be listed. Yeah. And then they're going to be able to compare the pictures and all that kind of stuff. So it's hard to fool people. There's a lot of information out there. So find the right level of renovations that you want to do, and then execute on that. And then that helps you kind of focus on the right property for you. And every once in a while, you're going to find some properties that you're going to find some unicorns, and they're going to show up in different colors and different shapes. But, so go through, and then don't try to go for the massive profit per property. Just go for base hit. Look for, for my properties, the properties that I was doing, I was looking for for our students, we're looking for about like $15,000 in profit, maybe $10,000 in profit sometimes, but kind of around that range for each deals that you're making. So, and people are going to say, well, that's not much, but yeah, but that's regular. That's something that you can do consistently. I'd rather have $15,000 once a month than, $30,000 every 6 months. This is like, you're going to pass on some deals, and then, and then you're going to have that money sitting in the bank, and then, oh yeah, there's a deal, I can do $30,000 on it. But, I can make a lot more money with the consistent list of properties that I can execute, regularly and all that kind of stuff. So that's my recommendation.
Yep. And it also depends from area to area, right? You have a margin, like, okay, you want a 10% margin, 15% margin.
Yeah.
In the areas where the home prices are low, you'll make 20, 30K. But in the areas where the home prices are like $500,000, about $1 million, if you apply the same rule, you make 100K.
Yeah, except for the flip, the houses normally don't cash flow if you go above like 200, 250K. I haven't found houses that cash flow above that. So that's the thing. I'm looking on the flip side, I'm looking for like a 10% return on investment. And if you do this project over like, let's say 4 months, well, that's like 30% annualized return. So it's a little bit more than that if you include compounding, but that's not bad. 30% return. I'll do that all day.
Yeah. Any bad deals that you came across? If you want to give an example, what was the worst deal that you encountered?
Yeah, there's a couple of deals. I mean, sometimes there's things that happen that you walk the property, or the realtor walks the property and everything seems fine. And then it was like a major storm, like water storm, like rainstorm and stuff like that. And then there was a little bit of a flooding around the area. And that's when we discovered like a foundation issue where the foundation was the water was just coming in. So,
Mhm.
we had to go, dig all around the perimeter. There's a couple of different ways to do it, but this one we had to dig around the perimeter and put like a barrier and a drain and all that kind of stuff. And so that was like, a few $1,000s, maybe, I think it was like $10,000 or $15,000 to have that fixed. So that definitely ate in our profit, but I don't think we lost money on that one. We even had a house that had a fire damage. We actually had someone go in there and set fire to the house, and we even made money on that one. So that's pretty impressive, I think.
Yeah. Let's see. You find one dud, sometimes, like one in 20 or 30 deals that you make, you find something. But as long as you don't lose money, that's good enough,
Yeah.
Mhm.
Yeah, we may have lost money like maybe on over 1,000 houses. Maybe we lost money on like maybe 5 houses that I remember. Vaguely remember. But you're consistent. I mean, you're consistent. I made money on the rest, so to cover for that.
All right. So any specific advice that you like to give to our listeners if they are starting up fresh in the same business?
Yeah. For me, well, obviously, I'm going to say flip system, you want to have something that's going to help you accelerate. It's very difficult to get started on your own. When I got started, if there was something like flip system, I would have definitely signed up for that. So, no hesitation there. But if you want to start on your own, it's totally feasible. You just have to take your time, and then be consistent, and you have to be self-motivated. You have to be very disciplined, well organized, and really focused. You can't have any distractions. That's where I found a lot of people, a lot of new investors. What happened is that they get started, and then they say, oh, I'm going to do wholesaling, and then they do wholesaling a little bit, and they say, oh, that's a lot of work. And then they go and say, oh yeah, some guy did like $1 million in multifamily in somewhere. So I'm gonna do multifamily, and then they start doing that, and then it's just like it takes a lot of effort, takes a lot of work, and finding the deal, and how am I gonna do the financing, where I'm gonna find the down payment, and all that kind of stuff.
Yeah,
and then they do something else, and they do storage, and they do so it's like pick something, and then
stick with it.
Stay with it. And if your goal is to achieve financial freedom, build a passive income portfolio, single family rental is the best way to do this. And the reason for this is not because it's necessarily the best investment in terms of return, cash on cash return, or anything like that. It's because you can scale it up over time. It's much easier to scale up single family rental portfolio versus an apartment building. Because if you try to look for apartment buildings, you're going to have to look at all kinds of different markets. You don't have team on the ground necessarily in these markets. You're going to have to potentially go there, fly there, do due diligence. Every deal is different. Single family, every deal is the same. You have consistency, and you can really scale it up, scale it down, and so that's why I think it's one of the best investment.
And for the other like apartment buildings as well as other commercial properties, right? The capital requirements are also large. So if you have if you don't have that much capital with or as well as if you don't have a base of investors who can work with you to invest that capital, maybe single family is the first thing you start with. That's how I got started with, doing fix and flips, short term. Some of the multifamilies, like 1 to 4 family, I used to keep it for myself. And then we pivoted to, construction of luxury single family houses, as well as small multifamily properties. We build about small multifamilies up to like 25 units over here in New Jersey.
Yeah, these are great. Yeah, I like them.
And we're pivoting to, build to rent type of method. So let's see.
Yeah.
So
So yeah, and the thing, yeah, and that's fine. Like, but start with a solid strategy. I think to me, like the easiest one is single family rentals. And then it doesn't mean that, oh, I will never do multifamily or commercial. It means that you get started with something solid, and then later on, once you get a network of investors, you get some opportunities also that are presented to you because you're an active investor. So
and it's not the get rich quick game, right? It's a long-term haul. You have to stick with it, work day, put some effort. It takes time for the fruits to bear.
Yeah.
All right.
Absolutely.
All right, Eric. So let's change the gears, and maybe if we can move to the final round of questions. Are we ready?
Yeah.
All right. So first question, which is the book that you'll recommend which had the most impact in your life or on your business?
So beside my own book that I wrote, Stop Trading Your Time for Money, the other one I think is 4-Hour Work Week. And the reason is because it was really totally a novel idea, and it was really the beginning of kind of the virtual assistant. And it just kind of like opened my eyes to some opportunities there when that got started. So I was 4-Hour Work Week, I think, really changed a mindset in me about that.
And I think I read it a long time before this one. It properly describes how you can leverage some of the services from others, so that you don't have to spend much time. You can outsource few things, and just compress your time to just as you said, 4 hours a week to get something done.
And so there was a lot of that about kind of like all the stuff that you're not, that is very repetitive, mechanical and stuff like that. Delegate that to somebody.
Delegate it.
Focus on what's really important to move yourself forward. So that was one part of it. And the other part of it was also about the focus. Like in his book, Ferris talks about, becoming this professional dancer and winning a competition. So he was just like, I want to win this competition. And then he just got focused on that. He was like, he didn't do all the different dance styles. He didn't go and do blah, blah, blah. And he just focused, this is the dance style we're going to do. This is the event we're going to go to. This is what I need to do. And then so that's the kind of focus that you need to have also when you're doing investings. And that's what I like about that. About his philosophy, just focus.
Absolutely right. So the next question is, can you tell us about a situation which you overcame with a strong mindset and turned out to be a great business decision?
Yeah, so I mean, the big one is we had a few very big things in the last few years. One of them was the pandemic. So pandemic was was pretty challenging. And with the pandemic, I mean, we had supply chain issues. We had also at one point when that happened, people didn't know what to do. Everybody was like, oh, well, am I going to invest in real estate? Am I going to buy real estate properties? Like, what's going on with all that kind of stuff? And so there was a lot of decision that needed to be made there. And we basically continued with real estate investing. But we changed the risk a little bit. We kind of mitigated our risk. We had a lot of properties that we were on private money lending at that point. So that means that I had to pay like interest every month to these investors. And I basically moved all of them to joint venture so that we would share in the risk. They would also share in the profit, but they would share in the risk, because I didn't know how long I would be able to, like the project that we were doing were basically like 4 to 5 months from close to close. And now with this, like, I didn't know if it would take like 6 months, 9 months, 12 months,
Yeah.
24 months to sell a property.
Uncertain,
So, I didn't want to be on the hook to pay 24 months of interest, because obviously that's going to kill me. So that's one thing that we did right. The other one is the interest rate. The interest rate spike of last year.
Mm-hmm.
We had worked on that like 6 months prior. And so we basically looked at that and said, well, where do we think the interest rate, our project duration was, let's say, 6 months, close to close. And then we said, well, where do we think the interest rate is going to be 6 months from now? And that's what we looked at. Because when we bought the properties, we're always looking at the buyer, the people that's going to buy the property from us, what's their cash flow going to look like. And then we would buy based on that. We said, well, the interest rates were going to be, it's not going to be 3%, it's going to be 5% or 6%. This was the assumption in 6 months from now. So we want them to have a certain cash on cash return. So what do we have to pay today for the property if we're going to be able to sell it to this buyer in 6 months when the interest rate is going to be 6%? So that was pretty critical. Obviously it really restricted the number of deals that we were able to do, but it also made sure that the deals that we were buying, we would be able to sell them to customers, because all our deal, we wanted them to make a certain cash on cash return and make sure that they cash flowed.
Mm-hmm.
We didn't want to be in a situation where we had properties with negative cash flows. So
so that was a nice move, actually, both of them, making your lenders a limited partner so that they can share the risk. So you hedged the risk that way. That was a good thing to do.
Yep.
As long as you had I think you had a prior relationship with them and they agreed to come on board. Certain people or certain financiers, they might not agree to do that. Yeah, but that's good. Next question, how would you like to give back to the world?
So actually, I have like an endowment fund. So we donate to a lot of people that don't have like a home or something happened to their home. So we do that in market. So I have like a fund called Martel Endowment Fund, and we donate to a different certain organization in the markets where we are. So in Cleveland, in St. Louis, in Memphis, and we help the community where we invest.
That's great. All right, final one. How can Decoding Cashflow listeners get in touch with you?
In social media, basically everywhere that says Eric Martel Official, Instagram, Facebook, TikTok. You can also look on my website, marteleric.com, and of course, flipsystem.com.
All right. Thanks a lot for sharing all the information to our listeners, Eric. It was nice talking to you. We'll stay in touch. Thanks a lot.
Thank you.
All right. Thank you.
Thanks for listening to Decoding Cashflow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cashflow, and we'll catch you in the next episode.